Hi, it's Jeffrey Cohen, Chicago Quantum Investment Advisor, Representative, and President of U.S. Advanced Computing Infrastructures. We're going to talk to you today about exchange-traded funds, what they are, why to use them, and the data set we're going to use is our Chicago Quantum Net Score run from Friday market close. The ETFs added to our models recently actually were very compelling. And so exchange-traded funds are stocks. They trade as stocks, but they're not actually common stocks. So what's the goal of this whole exercise? The goal of portfolio optimization as we see it is to maximize your future expected returns while minimizing your historical price variance. So what does that mean? That means I get more profit tomorrow, less risk yesterday, and we kind of hope that the risk moves forward. So you have less risk and more return. We also want to make the portfolios easier and less costly to manage because let's be honest, nobody makes money with stock commissions or paying spreads or options commissions or any of that stuff. We just want to invest the money and have it grow, right? We don't even like taxes. So maximize your future expected returns, what you're going to make, capital gains and dividends next year. Minimize historical price variance of the portfolio last year. And make the portfolio easier and less costly to manage. That seems like a reasonable goal. So what is beta? So we use beta to represent the systematic risk of a stock and the beta of a portfolio to be the systematic risk of that portfolio. And so a beta of 1.0 means a particular stock or an ETF would move with the S&P 500 perfectly. A beta of low-risk stocks between 0 and let's say 0.5, like food and utility companies, have low risk. Beta of high-risk stocks tend to be between 2 and 3.3. There aren't many of those, and those could be like unprofitable tech stocks, right? ETFs give us access to high beta stocks with lower individual stock risk. So we already start by getting more expected return, less risk. Now you'll notice we have TNA on the side here. TNA is an ETF. That's one of the ones we track. That's why we have it up here. Negative beta stocks move opposite the stock market. Imagine if you're afraid that the stock market's going to fall and you could put stocks in your portfolio that go up when the stock market goes down. That would be terrific. That would feel like you're getting like some protection, like buying insurance on that trip you're taking to Puerto Rico. It's like $30, but then they pay you for your ticket back and any damages and lost luggage and whatever. Negative beta stocks feel like insurance. There are ETFs with negative beta. These can add zig to your zag without having to short a stock. So what we do in real life is we will short stocks and go long stocks, and we play them against each other. But shorting stocks can be expensive. You have to borrow the money. You can lose more than you invested. You could be wrong and the stock could go up and you could go bankrupt. But with an ETF that has negative beta, you don't have those risks. You just lose money because you bought the ticker and it went down. So that's nice. That's an advantage. Now let's talk about very specific Chicago Quantum Net Score results. And to remind you, because you might not even know who we are, we're going to show you how to find our Chicago Quantum Net Score. You type in Chicago Quantum. You find all the other Chicago Quantums out there, which is fine. But you look for the one that says Business Consulting. This is the Chicago Quantum website. If you go to, Jeff, what are your advisory services? You'll see, we have separately managed accounts, stuff like that. We have videos describing it, but if I scroll down, the primary service that we have is a stock analysis. It's a fixed price offering. It gives you all this stuff. It's pretty cool, actually. And it costs $750, which I know for most individual investors is tremendously expensive. But if you manage money, this report, which can be delivered to you daily for $750, is amazing. It'll help you to make money in the market. There's a bull and there's a bear version. You can find your needle in a haystack. We look at thousands of stocks. Quantitatively, we run the model. It takes hours to run. And you basically get the optimized portfolio, the optimized stock portfolio. The best portfolio that we can find in the stock market that compares risk versus return. It's pretty cool. And you get all this other data too, right? And so what we do is we run these portfolios long and short, up and down, but we've recently started doing it a little differently. Let's talk about it. We now have a Chicago Quantum Net Score with or without ETFs. So what we have is we have, without ETF, without exchange traded funds, is the profitable stocks. So if you want to invest in only companies that make a profit, that has no ETFs because they don't have a profit. They're not a company, right? And then you have companies that are with or without profit, whatever. But we threw in a whole bunch of ETFs. So we added oil, the US dollar, gold, volatility indexes such as the VIX, QQQ, IWM, SPY, those are indexes, TNY, TZY, which is a long and a short portfolio. We're looking for actually a Bitcoin portfolio, but there isn't one that's traded on a major exchange. So we add them all in. So now you have profitable stocks, and then you have profit and unprofitable stocks with ETFs. So Jeff, what happened? And first off, why do I care? Well, let me explain. Take a sip of coffee. If you only ever invest in profitable companies, you will have a lower risk and higher return portfolio. You will make more money. It makes sense to invest in profitable companies. But like you, I like certain stocks that are not profitable companies. I like the promise. I like the transformation story. I just like the risk of it, knowing that if they make it big. Some profitable companies, if they go up 5%. You know, it's great. I made a 3% dividend. The stock went up 5%. I'm not retiring on 8%. But I have a stock that if it goes up, it triples. And if it triples, I'm going to buy a new car, right? That's great. I love it, right? New car, Jeffrey. So this is why you have to figure out how you can juice up returns of a portfolio that might have dog stocks or money-losing stocks, money-losing companies. Our Chicago Quantum Net Score run, which is profitable stocks only, has higher expected returns and lower variance. So, as of June 20, the expected return Oh, that's hard to read. Hang on, I'm so sorry. Wow, that's really hard to read. This is like the worst thing I ever did here. Oh my god, this is awful. Hang on, let's fix that. I know the last thing you want me to do is be fixing PowerPoints, but let's do it. So this is important, though. It's important that you understand how we're thinking about it. So I'm going to give you this as a nice, right there. So if you only run the Chicago Quantum Net Score with profitable stocks, the expected return is 0.74 or 0.75% higher per year. That's pretty amazing. I can't get that. Can you get that? That's hard to get. The variance is 2.5 times 10 to the negative 4 versus 3.6, which is, shoot, that's really high. Right? So if I were to do the math on that, it's 40%, roughly speaking, it's 40% higher variance. By including companies that lose money. So the reason why we don't do this, the reason why we have a whole offering that strips out the unprofitable companies, is because your expected return is 0.75% higher and your variance is 40% lower. By only including profitable companies. Okay, so hopefully that makes sense to you. So if you're asked the question, why would I look at stocks that make a profit only? They have higher expected returns and lower variance. Okay, that's cool. What else you got for me, Jeff? So you can overcome that handicap with ETFs. When we add ETFs to our all-stock run, we make up the handicap. What does that mean? That means we get the same answer. We get the same edge. With only 9 stocks held evenly versus 7. So it's only 2 more stocks. You got the same edge. You've overcome the handicap. That's terrific. Jeff, I'm done. Thank you so much. You added some ETFs and you just showed me that by holding 2 more stocks and ETFs, I can add profit-losing companies to my portfolio and not suffer. Well, it's one way to look at it. The other way to look at it is most people don't only invest in companies that are profitable. Most people don't do the homework. They don't run the analysis. They don't read the 10Qs and 10Ks. And so they just buy the stocks that they like. And unfortunately, they have the handicap. So you can overcome the handicap with ETFs. Okay, that's amazing. Fine. So what ETFs do you use, Chicago Quantum? Well, this is where it gets a little ugly to look at the chart. I'm going to do my best here to make it nice and easy to read. It is, wow, this is tough to read. Let's try. So TNA, which is what's over here, is a direction daily, and they spell this wrong, which I love. So if you look, it's spelled wrong. Direction daily small cap bullish, 3x shares. Invesco has the QQQ. We have the Spider, which is the S&P 500. Shy. It's a 1 to 3 year treasury bond ETF. So you can put bonds into your stock portfolio. By the way, that's not so bad. You can also do 20 plus year bonds and 1 to 3 year bonds. Oh, that's just duplicated. I'm so sorry. You know, I got a couple dupes because I was copying and pasting in odd ways. So, all right. That made it a little easier to read, too. So, you've got your Russell 2000. You've got physical gold. You've got oil. You got the VIX. You got an ultra short. You got a small cap bear shares. You got a dollar fund, dollar index fund. You got an ultra VIX short-term 2X, and you got a pro shares VIX short-term futures. So this is a lot of different types of, these are a lot of different types of ETFs that you can add to your portfolio And you can feel good about it, right? Because you're getting some different stuff. So I'm just going to reorganize it by stocks versus commodities, right? I love this because, and this is where I would hope that you would ask some questions if you're out there. You may not be out there. But I just find this super fascinating, right? So I always thought to myself, if you took a portfolio and you added other types of assets, and I thought to myself, would that help you? I think the answer is yes. It does help you. If you can add other types of assets, it's going to help you. The problem is that other types of assets at times can be very expensive. Let's say you wanted to add emerging markets. Now you have to find someone who's going to fly all around the world and invest in emerging markets for you. Now I think the ETFs are a little more sophisticated and a little easier to invest in. I'm not saying that they're perfect. I'm not saying that they're going to give you everything that you need. But these seem to be pretty reasonable picks. There you go. Got it nice on the page there for you. They seem pretty reasonable. And as a result, you can now equalize. So we're going to run back real fast through this so that you understand. Because to be honest, this took me months to figure out, and I'm giving it to you in a minute. So why use exchange-traded funds? The goal is to maximize the benefit of U.S. equity portfolio optimization, or just maximize U.S. equity portfolio optimization, and you do that by three things. It's kind of like the Fed. When the Fed says, oh, we have a dual mandate, do you know they have three things? And in our case, you want to maximize expected returns, minimize price variance, and make the portfolio easier and less costly to manage. We're going to just say it's not so much a matter of ease. Make the portfolio less costly to manage. Okay? That's good. Beta is systematic risk. This is just a learning, right? There are not too many high beta stocks. And they tend to be idiosyncratic. They tend to be have asymmetric risk. Okay, that's fair. ETFs can give us access to high beta stocks with lower individual stock risk, with lower risk. That's what we really mean. Because you're not dealing with individual stocks. Okay. Negative beta stocks move opposite to the U.S. stock market. There are ETFs with negative beta. These can add zig to your zag without shorting, without having to short stocks, which can be challenging, right? So negative beta stocks move opposite to the stock market, but can be anomalies and meme stocks. So that's interesting. Chicago Quantum net score results. The Chicago Quantum net score, I should spell that out. is run, the Chicago Quantum Net Score is run with and without ETFs. We run ETFs and all stocks versus only profitable common stocks. So we run all stocks with a few ETFs. See, you're going to make it a little clearer now for you. The good news is you're understanding the thinking versus only profitable common stocks and no ETFs. Okay, thanks, man. Our Chicago Quantum Net Score uprun, profitable stocks only, has higher expected returns and lower variance. So this is changing nothing. This has nothing to do with ETFs. This says there you go. No, there you go. If you want to take advantage of the Chicago Quantum Net Score, uprun, profitable stocks only, has higher expected returns and lower variance. So there's an advantage of only picking profitable stocks. Uprun, I don't think you need it. Profitable stocks has higher expected returns and lower variance. Okay. We're going to make it a little smaller for you. There you go. Nice. So you can overcome the handicap with ETFs. Overcome the all stock handicap with ETFs. When we add ETFs to our all stock run, we make up the handicap. That's amazing. We find the same edge, 2.0 times 10 to the negative 4, with 9 stocks held evenly versus 7. Okay. Versus 7, nobody has any idea. Two more stocks. All right. Select ETFs we analyze. These are the ETFs that we're analyzing. And that's the close. I want to thank you for watching. If you learned a lot, if you feel good about it, if you're like, oh my gosh, Jeff, this is so terrific, then give us a shout out. Appreciate that. Take a look at our homepage. You can actually find our brochure, and we're updating the brochure. Find our brochure. We're updating the brochure to talk about some of the runs that we have and the different services and the cost of those services. And you can get some free insights as well. And if you like it, check out our YouTube page. Hit the subscribe button and maybe share the link to the video. That helps us a lot too. Thanks again. You guys take care now. Chicago Quantum, U.S. Advanced Computing Infrastructures Incorporated. I'm Jeffrey Cohen, Investment Advisor Representative. Thanks.